everyone, good evening and welcome to the Money Show. Remember, this is the only show which caters to you, the viewer, to give you top financial experts to help you in any financial related queries. I'm Avan Dubash and with me is Avni Raja. Hi Avni.
Hi Avan, we've got lots lined up for you, but first let's take a quick glance through at the headlines. Well, it's been a range-bound day on the Lal Street. Nifty trades in the positive zone, attempting to recapture the 10,400 mark. Small caps continue to steal the limelight from the benchmarks. Realty and pharma spearhead gains. However, IT stocks remained in the spot of bother.
Meantime, LIC will stop selling its popular annuity product Jeevan Akshay from next month. The single premium plan, which generated revenues of 10,000 crores this year alone for the insurer, offered returns of 0.5% more than 10-year G-Secs. But with falling interest rates, these returns are difficult to sustain.
And Bitcoin seems to have become the flavor of the season. Registrations at leading Indian Bitcoin exchanges have doubled in the past few weeks given the recent rally to an all-time high. However, as it crosses the $10,000 level, it has also triggered warning signs of a bubble in the making.
Okay, those were your top stories at this hour. Let's also bring on board our guests who will be joining us over the next 30 minutes. And as promised, today we have with us none other than Dhirendra Kumar. He's CEO of Value Research. He'll be answering all of your mutual fund related queries. And we also have Nimesh Shah, Managing Director, CEO, ICICI Prudential. The reason Nimesh is with us on the show today is to talk about the big bet on India's growth story, and that's the Bharat 22 ETF. It hit the bourses and it was a fairly modest listing. But Nimesh, let's talk a little bit more about this new fund and how you see the prospects of the Bharat 22 ETF over the next 2 to 3 years. Do you think that people should hold on, enjoy full returns, or even book profits?
See, each of the companies that we have selected are the companies that will benefit by what is the government doing today. Right, that's how each of the companies, and we had taken those companies with a 3 to 5 year perspective. So if the government is taking up some initiatives today, it will help the growth of EPS of those companies in the next 3 to 5 years. So investors who have come into this fund to get the full benefit out of this fund, they should remain invested in this fund for the next 3 to 5 years to get the full benefit. That's what I feel.
Nimesh, help us understand the overall investing environment really which the Bharat ETF is getting at this point.
Yeah, this is the exact thing that we were talking about when we had launched this ETF and when we were talking to ET now, say 15 days back. And our theme was that the private sector is not, the capex cycle of private sector is slightly far off, and government is going through the capex cycle. So if we have to invest in companies which will benefit from the government's capex cycle. So the whole focus of this ETF has been that. So I think things are going as till now things have gone as per what we thought the direction in which they will go. But anyway, we are investing with a 3-year mindset. So 15 days or 1 month is not going to change things dramatically.
All right, Nimesh, thanks very much for taking time out and joining in and giving us a lowdown on the Bharat 22 ETF and as well as what kind of prospects we can see. In fact, let's take it across to Dhirendra Kumar, who is our guest for the day. And Dhiren, I just wanted to get in some comments from you as well. You know, with the issue size having been raised to 14,500 crore rupees from 8,000 crores, it was the highest subscription ever for any NFO. What's your analysis or what's your expert take on the Bharat 22 ETF?
One is that it's a very unusual kind of NFO. You know, it was created as an and it's a very unusual kind of ETF too. It's an ETF which has little bit of character of an actively managed fund, because there is a ceiling. The fund manager will actually sell the position which appreciates. So that might translate into an opportunity loss, but that will also translate, ensuring diversity of the fund always. It's not a PSU fund because nearly 39% of it is in private company, which government accidentally happens to own for some legacy issues or for some historic reasons by virtue of UTI's split and ownership. But that apart, I think I reasonably agree with Nimesh that this is a very promising set. It is a fairly diversified fund. These are relatively cheaper stocks in the in the stock universe today, and things can change dramatically for many of the underlying companies, even the 60%, the PSU. And also, we have seen various kind of, formulations, disinvestment in the past, or, offer for sale opportunities. Also the CPSE ETF, which was a dominantly, energy fund. Compared to that, this looks like a fairly well diversified, relatively cheap underlying stocks with the flavor of, and very high quality PSUs, because not to mention that, look at the selectivity. We have nearly 250, public sector companies, of which many of them are, closed down or they are loss making. Of the profitable set, we have a lot of metal companies, and of course there is a missing element in this, because government has already sold out its, the CMCs and many other such companies. But I think, BEL is a somewhat a proxy of that, or Engineers India, or some of these services companies. So from that standpoint, it looks reasonably diversified, fairly attractive from a valuation point of view. And but I think, by and large, most ordinary investors should try and achieve great diversification. Actively managed funds still have, hold far greater promise. But this looks like a fairly attractive proposition at this point.
Right, Dhirendra, that's as far as the Bharat 22 ETF is concerned. Dhirendra, we're going to get to our first query that's coming in from Satish Kumar, who says, I have invested in ICICI Pru Value Discovery Fund and it's not been performing well compared to other mutual funds. Should I remain invested in this fund or switch to another fund via the SIP? Please share your advice. Dhirendra, this actually Value Discovery Fund, one of the better funds that are there in the market today, with about more than 17,000 crores AUMs, and it's given 22% returns since its launch. What would be your advice? Hold on to this fund given its track record, or do you think there is some issue there as far as performance is concerned?
No, there is absolutely no issue. I think, investors need to understand that if you are investing for a couple of years, this is the kind of fund which you should have. This is the kind of fund which will not do well continuously. It will not do well continually because, this is a fund which, and particularly in a racy market of the kind that we have seen, where everybody is expecting a correction and waiting to invest. This is the kind of fund which actually takes follows a value oriented approach, and, it looks for such relatively, different kind of positions. It does not get into the the racy part of the market, higher valuation, or of course most mutual funds are fairly quality conscious, but here this is extremely value conscious in terms of paying. The fund manager, the starting point is buying a stock in its portfolio where he should not be overpaying for anything. And so in that context, this fund will always look poor, of the kind of market that we are witnessing right now. But if you are investing for 3, 4, 5 years time frame, one should invest. In fact, if you are investing 100 rupee, 50 rupee should, or 30, 40 rupees should be invested in such a fund. You can well invest in the racy part, which is doing well in a rising market. This fund will be like this only. Of course, there is one apprehension that I have, that the fund built most of its track record on a relatively smaller base. It also built its portfolio because it was launched in 2004. Since then, a 22% annualized return looks outstanding. It was built on a slightly different kind of strategy, because and of course the strategy remains the same, but the kind of stocks that worked for this fund where its universe could have been much larger. Now the fund has to operate with a relatively smaller universe, but I think the fund manager remains like-minded in terms of the way he thinks, the way he has gone about managing the fund. Even now, even if it's turned big, it will be a missed opportunity for him, that he will come across similar opportunity which are relatively smaller sized, so he may not be able to take a meaningful position in them. Except for that, I don't see much of a change. And so this fund is a worthwhile fund, even though it's not doing well.
a stamp of approval on ICICI Prove Value Discovery Fund. You know, you can just take a glimpse of the returns as well that the fund has given to get in a better sense as to how it's shaped up. A year-to-date return of about 20.6% in the last 3 months. It's given a return of about 5.6%. And Dhirendra also spoke of some of the concerns, but by and large, I hope we were able to answer your query, Satish. Hold on to this fund in your portfolio. Well, next up, we've got a query coming in from Prasad Patwardhan on Twitter. This says, the NAV of any scheme is calculated by dividing the net assets by the number of outstanding units. How are the number of outstanding units calculated with daily inflows and outflows? There is bound to be an overlap of underlying stocks held by equity mutual funds. What should be the ideal overlap percentage? A little bit of a technical question, Dhiren, here, but just, you know, help to set things right and just explain the math when it comes to NAV and, you know, the overall overlap percentage as Prasad flagged off.
No, in fact, he is asking two questions. One is that how is the NAV calculated, and because there will also be inflows and outflows. And the second question is that how should he look at the, you know, the overlaps of his, you know, there's bound to be overlap. I really can't really figure out this. I think he's asking about, you know, if somebody holds two funds, there is bound to be some overlap. No, I would like to explain it to him how the NAV is calculated. It is the net asset value or the net assets of all the underlying positions held by the fund divided by the total number of units outstanding. Based on that valuation, that day's redemption and that day's, you know, inflows, all the purchases and redemption requests, they are squared up, and depending on the inflow, you know, whether there is a net you know, accretion in the fund, or there is a net inflow in the fund, or there is a net outflow in the fund, those money units at that day's price, you know, because that is the basis of allotment of that day, that money is taken out, and then the remaining money gets invested in the fund. And there is always some cash position in the fund from which this cash moves out if there is a net outflow on a daily basis. Of course, before this, the expense on a daily basis is also deducted. So there is absolutely, you know, this is a simple way. I have just tried to explain it with simplicity in terms of, you know, of course, there will be a lot of assumptions here, because even an equity portfolio will have some cash position or something invested in the overnight market, or, you know, every asset will be valued based on the valuation matrix or the valuation procedure specified by the regulator, or based on the daily closing value, or there could be an illiquid position. So, of course, taking all those nuances into account. After that, so value of assets divided by total number of shares, total number of units outstanding, less expenses, after you know, depending on net inflow or outflow, which is netted on a aggregate basis on every day, and then those allotment or outflow happens. So there is absolutely nothing. There is no case of, you know, individual investors' position in individual stock is not there in the picture at all. So the fund manager, next day morning, he has an understanding that how much cash is there in the fund, or if at all he has to sell something to create a cash position which might be needed for. So that's the fund accounting which reports on the cash flow position of the fund on which he can act. There isn't a matter of, you know, overlap or overlap or, you know, any kind of disconnect. There could be a, you know, I think he was trying to ask about overlap in the two fund that he might have, and there are tools where he can figure it out himself.
All right. Well, Prasad, hope you've got that answer that you were looking for and understood the entire concept of how the NAV is calculated and the answer to your questions as well. On that note, let's slip into a quick break. We'll come back with several more queries. Meanwhile, you can send us all your personal finance related questions and we'll get them answered for you right here on The Money Show. Welcome back. You're watching The Money Show and we have with us Dhirendra Kumar to answer all of your personal finance questions. Dhirendra, before we get to our next set of questions, I want to pick up one very important topic of late, which seems to have become the flavor of the season, which is Bitcoins. With, it's crossed that $10,000 level now, and we've had a lot of retail investors writing into us wanting to know how they can really invest in Bitcoins. Of course, it really needs a warning here to ask retail investors to stay away from this, which could be, a bubble of sorts, and you could end up losing a lot when that fall actually happens. What is your take on it?
Yeah, absolutely. You have summarized it, and I would like to second it that it has taken the shape of a currency which is not backed by a government, and it is going up because it is going up, and people are buying it, so it's going up, so people are buying it. And today it has lost the charm of being even a currency, the high valuation or the capitalization of Bitcoin. Cryptocurrency might be useful. The blockchain technology invented in the course of this can actually make our digital transactions safer. It can have some lot of implication for the way we conduct business or the way we move our money around, and the need for it to become safer in future, because more and more digital transaction, or that will become the way of life for us in future. That doesn't mean that Bitcoin will become valuable. In fact, it is going up, and it's a classic bubble situation, that it's going up because it's more people are buying, and more people are buying because it's going up. It will cause misery, it will cause pain, and most bubbles get created like this. We have a history of that. There is a full long history of few centuries where people start speculating in something and all kind of stories get woven around it. It's a musical chair, and finally somebody will be left standing. So be careful, be watchful, take it as a fun. And today the denomination of a unit has come to a point where something very meaningful will be at stake if you want to dabble in it.
Dhirendra, and also for our viewers, a word of caution that Bitcoin does not have any sort of legal standing, and especially in India, it has not been endorsed, backed by the RBI in any manner. So it's best, as Dhirendra has been saying, to completely stay away from the Bitcoin, at least for now. Well, on that note, let's get our next question, which comes in from Ketan Nayak, who says, I'm currently holding DSP Microcap and Mirae Asset Emerging Blue Chip Fund. The fund has stopped taking bulk queries. What does this indicate, Dhirendra?
Yes, these two are, Mirae Asset Blue Chip, Emerging Blue Chip Fund is a mid and small cap fund, and so is, Microcap, as the name states. It invests in very small companies. The design of this fund, DSP BlackRock Microcap, has turned out to be a fairly large fund, over 7,000 crore. It invests in very small companies. It does not, by its very design, its stated objective is to not invest in the top 300 companies. It will invest beyond top 300 capitalized companies in the country. And there, going by the valuation, the way, the size of the amount of money investors are pouring in these funds is becoming a deterrent to its performance. So the fund has these funds have stopped taking lump sum, large amount of money, and you can carry on with your SIP. So there is a message here. The message is that the fund is finding difficult to manage large amount of money flowing into these funds, and it is finding lack of avenues. It will be a compromise on performance. It will lose its charm if it accepts all the money that is coming its way. And it is the second point is that if you should lower your expectation. What these funds have actually, it clearly indicates that the kind of return that we tend to expect, or that the kind of return that we have got from these two funds in recent past is unlikely to be repeated in the past, in recent future. So lower your expectation, carry on with your plan. And also I would like to mention here that these are funds which are extremely cyclical. Small and mid cap funds tend to move in huge, big cycles. Their performance or gross underperformance are, it happens in a very narrow time frame. So lower your expectation, carry on with your SIP. It might turn out to be good, good for you if there's a huge, if the markets fall, or these stocks actually fall more. And if your time frame is not that long, if you are still not investing with 5-7 years time frame in mind, maybe it's time to cash out or lower your exposure to such funds.
Absolutely. Dhirendra, the next question coming in from Vishal Bhatt, who says, can the problems within ADAG Group have any impact on my investments in Reliance mutual funds? Perhaps this can also be extended to even other, such kind of funds where the underlying securities sometimes go through issues. What would be your advice?
There are two aspects to it. One is that ADAG, Reliance Nippon Asset Management Company has recently got listed, and so implication for that company and the implication for the mutual fund investors in Reliance Mutual Fund. Reliance Mutual Fund investors are reasonably insulated in a sense that whatever happens, this fund company has gone on running very independently, and it is not strictly ADAG Group. Theoretically we have this concept of group or a promoter group, but it is Reliance Nippon Asset Management, and they are equal owners in this company. Asset management business is reasonably ring-fenced by the regulators. Also, there is a unique structure in India, which is, all the assets of the individual funds is there in the trustee's account, or, when we invest in a mutual fund, we do not give our money to Reliance Capital Asset Management. We don't write the check in their name. We write the name of, Reliance Growth Fund or Reliance Vision Fund, or, whichever be the fund, and there is a separate fund. The securities are lying with the custodian. If ADAG Group decides to liquidate its position in, I'm not aware of any such thing, but assuming that they want to, so the shareholders can sell their stake in the company, and there could be takers. This IPO did reasonably well, it's settling down, it's the first ever listing, so that's one aspect. So the mutual fund business is reasonably insulated by the shareholders, insulated from the shareholders. Also, I feel that despite the ups and downs, great ups and downs with many of the promoter groups, the mutual fund promoted by them have been kept away. Our regulations have been able to insulate the fund investors or fund investors in their promoted companies reasonably okay, and there is a substantial disclosure about how what connection the promoters have, or any related party transactions and other things. Today this fund company has turned so big that those things are completely immaterial, and I think they have withstood the test of all these turbulent times.
Right, that's Vishal. Hope that answers your question, but we're completely out of time on this edition of The Money Show. Thank you very much, Dhirendra, for joining us and answering all of those queries. We'll continue to take your queries, so keep them coming. We'll be back with a brand new episode of The Money Show.